You've been lied to. Your loan officer said they went over all the mortgage options with you, but actually didn't. There's qualified mortgage, which is QM, and non-qualified mortgage, which is non-QM. No, they're not some bougie, cool acronyms in the mortgage space. They're actually two distinct different types of mortgage product buckets. And if you have the wrong one given to you by your loan officer, you might get denied for the mortgage, or worse yet, overpay and spend hundreds of thousands of dollars in interest you never had to pay. I'm Andrew Russell, owner and founder of RCG Mortgage. I specialize in helping home purchasers get the home of their dreams and those looking to refinance put themselves in a way better financial position. So I had this client referred to me, and his name was Greg. If you know, then you know. Now, Greg was a self-employed business owner, and he made the typical mistake. And as a self-employed client, he actually applied for a mortgage through the bank that had all his money, his checking, his savings, his 401k, his retirements, all that good stuff. And it turns out he had over 20% for the down payment, which is great. He had a 750 credit score, which is phenomenal. But what he didn't have was income. Now, again, QM versus non-QM, a qualified mortgage, a conventional mortgage, they asked Greg for 2 years of his tax returns. Now, he met all this money coming into his business, all this revenue coming every single month, which turned into a year amount that was very high, right? 2 comma club. Greg was in for sure from a revenue perspective. But he wrote off all his expenses. So what he showed as a net to the IRS, a net income, a net profit versus his revenue, wasn't high enough to qualify for a house. Super upset, him and his wife, they actually had children. They were looking to buy about $1 million property with 20% down, and they just couldn't get approved for it. Now, Greg was referred to us, and we said, we took a forensic once over. We took a peek at 30,000 feet, and we said, you're looking to get a qualified mortgage, but you write off all your income. You should be doing a non-QM, a non-qualified mortgage. What does that mean? They look at income just a little bit different. Specifically, we asked Greg for the last 12 months of his bank statements. We looked at all the money coming in, all his deposits, and that's what we based the income off of. We look at the deposits, and we take a percent of those deposits as an income number for Greg versus looking at his tax returns. We don't even need the tax returns. So alas, we were able to qualify him for the home. He was able to make an offer, have it accepted, and close all within 30 days, all because he was referred to a mortgage company that was a mortgage broker company that had access to these non-QM loans, which the big banks typically don't offer at all. And the advice that you're given from the salesperson is actually, no, you don't qualify. That's not the truth. Salesmen at these big banks, not the truth at all. The reality is you're just being presented the wrong loan options, and Greg, it turns out, actually qualified. Now, I hear you saying it right now. Hey, Andrew, non-QM, what does that even mean? Are we going to have another 2008 crash? No. We're not going to have another crash. Why? Because equity positions are high. They require a higher down payment. They look at your credit and require a higher credit grade. They require a lot of money left over in the bank after you close, and typically, all of these loans are fixed rate, meaning the payment will never change. So I can tell you, the issues of the crash won't happen again. Why? Because the equity positions are high, the down payments are higher, the credit grade is higher, meaning their credit score and how they pay their debt is exponentially better than what it was during the crash. And they have money left over in the bank, and the fixed rate mortgage versus the adjustable, if the payment's affordable, then it's affordable. It's not going to change. And I can hear you saying it now. I'm sure these are predatory loans and the rates are a lot higher, right? Actually, they're not. Depending obviously where we are in the market, when we had the kind of sort of product come off the shelf during COVID, and there's a lot of uncertainty. Once it came back, and then here we are, the difference of rate, of course, it's going to be a little bit higher at times than a conventional loan, but the difference of rate, say the rate right now is 6.25 on a conventional loan. We've seen rates as low as 6.75 on these. So for instance, a 0.5% gap, meaning if the going market rate 6.25, the rate on these programs is only 0.5% higher, which is very reasonable and very fair. And I also hear you saying, hey, Andrew, this non-QM sounds shady. How about we just wait until I qualify for a QM loan, for a conventional loan? Now that could be the case, but what I've seen people do in that same type of headspace, you're going to have to show a lot of profit to the IRS, which means you can't write off your expenses, which are probably all justifiable, which means although you show a higher profit and now you qualify for a QM loan or a conventional mortgage, you're going to have to pay the IRS a lot of money. So we've actually looked at the differences of a client not writing off their expenses and qualifying for a qualified mortgage or a conventional mortgage versus writing off their expenses as they typically do and qualifying for a non-QM or one of these bank statement programs that we went over. And the difference of 0.5% in rate versus all the money they'd have to pay back to the IRS but not writing off their allowed expenses, it just didn't make any sense. So we're going to address all the concerns and all the differences of what a typical qualified mortgage is versus a non-QM mortgage in a clear, concise way so you have facts and not fear. So let's talk about qualified mortgage and what does that even mean? It's kind of a newer term. What falls into this bucket? So of course, who did I defer to? The good old CFPB. So with that said, qualified mortgage are the typical type of loans, right? The Fannie Mae, the Freddie Mac, the FHA, VA, government mortgages, they all typically fall under this qualified mortgage bucket. So it's loans with less risky features, protections that make it more likely to be able to afford your loan. They do a substantially higher vetting process of credit, income, and assets. Now remember, when you qualify to potentially buy a house or to do a refinance, they're going to check the credit, the income, the assets, and even the collateral of the property to make sure you qualify. Now credit, of course, they do a tri-merge credit pull. There's a soft pull, there's a hard pull. Soft pull gives us mortgage guys what we need to review, but it actually has to be converted to a hard pull, which yes, there'll be an inquiry on your credit report, but typically credit reports are good for 4 months. We look at your credit score, the middle of the three. So typically, if you have a husband and wife, and say the wife, of course, obviously give the wife the better credit score. I'm not stupid. If the wife has an 850, a 750, and a 650, her net effect credit score is a 750. Now, if the husband has a 700, a 600, and a 500, his credit score is a 600. We're going to go off the lower of the two, which would be the husband. So we go off the lower of the two of the borrowers, depending if there's more than one borrower, but we take the middle of the three. And they look at the credit profile. If you have a mortgage already, are there lates? Lates are no bueno right now. That's something we take into account. You have the ability to pay, which is, of course, income, but the capacity and the willingness to pay. So as it relates to credit, if you have a lot of credit cards, if you have car loans, if you have student loans, are you actually paying them on time? Do you have 30, 60, 90, 120-day lates, which is, again, no bueno? Because think about it. If you won't pay your Bloomingdale's card on time, why are you going to pay your $800,000 mortgage on time? So these are the things that the lenders and the underwriters look at in a qualified mortgage and the credit component. Now, the income, the way they look at income changes typically year over year, but oftentimes it's pretty much the same. So specifically, if you're a W-2 employee, they'll look at 30 days of pay stubs. They'll typically want the last couple of years of your W-2s, and they'll see what's your income look like. Where's the trend? Is your income going up? Is it staying the same? God forbid, is it going down? What is it comprised of your income? Is it base, which is guaranteed? Is there hourly, which fluctuates? Is there bonus? Is there overtime, commission? All sorts of back-end guidelines to figure it out. But that's part of the qualified mortgage income review process. What is your income mode? Now, self-employed, in the case of Greg, of course, self-employed is very difficult when you get a QM or a qualified mortgage because, again, they're going off your tax returns and going off the net. Now, being a self-employed business owner, the tax return itself is specifically made and prepared and geared off of writing off your expenses because that's the benefit of being self-employed. You get to write off expenses and pay money on your net profit, not the all-in revenue that comes in every single month. But unfortunately, you're talking to a guy that's worked with thousands of self-employed clients. More often than not, clients take the ability to be able to write off their stuff. Listen, even the president of the country applauds how he's able to write some stuff off, right? So we go off of the profit, and typically the profit is never good enough to get the job done because these people make more in their opinions, but that net profit number in the tax return doesn't get the job done. That's why QM is a very difficult mortgage type when you're self-employed. The third piece of a qualified mortgage is always a review of the assets. Now, typically they want to see 1 to 2 months before, if you're buying a house, contract. Sometimes on a refinance, they're not all that concerned with assets. They'll want to see the money that's coming in, where is it coming from? Is there a large deposit, which may be more than you typically get? Where's that coming from? And we kind of source it. So there's a lot that goes into the asset stuff, but typically they want to see if you're buying a house, where's the money coming from? And do you have the ability for a down payment? Have you been saving? Have you been a good boy or girl and you're allocating monies on the side to buy a house, or are you paycheck to paycheck? And there might be concerns that you pay the mortgage, hence the qualified mortgage. Now, of course, the CFPB adds a lot of other cool stuff from a qualified mortgage perspective. So to paraphrase, it includes all government-backed loans guaranteed or insured administered by the good old Housing and Urban Development, the FHA, the USDA, which is the U.S. Department of Agriculture. We went over VA loans, which is a part of it. All of the mortgage, including conventional loans backed by Fannie and Freddie and jumbo loans, they're part of this, but they do have to meet special requirements to be considered qualified loans. So the lenders have to make a good faith effort to determine the ability to repay the mortgage. This is known as the ability to repay. So if your loan's a qualified mortgage, it means the loan met certain requirements, and it's assumed that the lender followed the ability to repay rule, which is everything we just went over. So generally speaking, a qualified mortgage, it has no risky loan features such as interest-only period, which means, for instance, if you have an $800,000 loan and it's an interest-only, say the rate's 8%. 8% of that $800,000 mortgage is $64,000 a year in interest. You divide that by 12, it's a little over $5,000 a month. And if you pay that, it's just interest. Now, if you're just paying interest, it's considered risky. Why? Because you're not paying down any of your principal. So they've classified, and this was a big loan during the crash. A lot of people took these interest onlys and more exotic and didn't realize. A lot of people took these interest onlys and didn't realize that they weren't paying down their principal, and they got super mad. So it's just something that the CFPB has called out, that interest only is no bueno for these qualified mortgages. Negam was a super popular loan during the crash, and it caused a lot of problems. Why? Because people, I guess they didn't read the fine print. The disclosure requirements aren't as high as they are now. And when you get a negam, typically there are 4 loan options. There was a 30-year fixed option. There's a 30-year fixed interest-only option. There's a 15-year, which is obviously the payments can be a lot higher. And there's this magical negam payment. So a client's like, well, listen, if I'm going to make my mortgage payment, I could pay $4,000 a month for a 30-year fixed. I could pay $3,500 for the interest-only. I could pay $5,500 for the 15-year fixed, or I could pay $1,500 a month for this negam payment. I'm just going to pay that. What could go wrong? Well, it turns out you're only paying a portion of that month's interest, and what you don't pay was tacked on to the loan balance month after month after month. So you have a mortgage at, say, $600,000, and next thing you know, you're like, why is my loan balance $700,000? Because you've been paying the negam payment. And at the time of the crash, the values, the equity positions were going down because the values in America were going down. We were having the crash. So in a refinance, they base what you qualify for based on your loan to value or how much equity you have. So now all of a sudden your loan balance goes up. Follow me. The value of your house goes down. Clients can't refinance because not enough equity to pay off the loan and cover closing costs or even qualify nonetheless. And what do? They stop paying. They foreclose. You see where this is going. So they took this mortgage type and said, nope, it's not a qualified mortgage. And frankly, they're not even really offered anymore. And lastly, balloon payments. Balloon payments are if you make a monthly payment and at some point during the mortgage, you have to pay the whole thing off just like that. So that type of stuff is not allowed. So it limits the price of the loan as well. They want to make sure that your APR, your interest rate, is not exponentially higher than certain indicators that they go off of, which is super important. And that's what makes a qualified mortgage so great. They limit the upfront points and fees. They want to make sure that you're not paying an egregious amount of closing costs. So there's actually a limitation, which is great. Ensures the consumer gets a better deal by getting a qualified mortgage. And they make sure that you consider and verify income, assets, and debt, which is important. And again, in the ways that we said, income, they have a certain amount of documents to check depending on the loan type. Credit, there's a certain requirement for a credit score and a credit profile and mortgage lates or lates on debt and all that good stuff. And of course, assets, making sure you have enough money to close, making sure you have enough money for potentially reserves. What's a reserve? A reserve is a mortgage payment. Say your mortgage payment is $6,000 a month. If you have $6,000 left over after closing, you have 1 month reserve. So reserve is money left for a rainy day. They don't hold it. They just want to see it and know that you have it. If the mortgage payment is $6,000 a month and you have $60,000 left over to your name, you have 10 months reserves, meaning, God forbid, rainy day, you could pay your mortgage for 10 months and not have an issue. Now, we just talked about QM, qualified mortgage, the typical mortgage you hear about when you walk into your local bank. Now, what we'd love to bring up now is non-QM. So non-QM is a mortgage product in a space that was created for if you fall out or don't qualify or it doesn't make sense to do a qualified mortgage. What are typical loan types and products in the non-QM space? You have a lot that are geared towards self-employed clients and investors. Specifically, say in the example of Greg, he had a high amount of revenue coming into his business every month, but he wrote off all his expenses. So when he applied for a QM loan, he didn't qualify because his net profit wasn't high enough. So we did a bank statement loan for him. That's a huge type in the non-QM space. It looks at the last 12 or 24 months of the borrower's bank statements. It looks like the money coming in, which is the revenue. It gives them credit for anywhere up to 50% to 90%, believe it or not, of that revenue coming in for their monthly income number, and that's what we use to qualify. That's an option. There's another option where they go off 1099s. So if you're a 1099 contractor, instead of looking at a Schedule C, or again, the whole revenue, expense, net profit, we'll go off the 1099, which is super cool. There's some asset-based lending, which is you have a ton of money in the bank. Clearly, you could pay this mortgage off just using your assets. That's a piece of it. And of course, a new one, which is super popular, a profit and loss program. So you have a client who owns a business. They prepare a profit and loss, which is this is the amount of revenue we make. These are our expenses. They write them out. And this is the profit that we have off of the last 12 or 24 months. And that's the document versus a tax return. Now, this is very typical for primary and secondary purchases. For investment purchases, all the rage. You've been living under a rock if you've never heard the acronym DSCR, or Debt Service Coverage Ratio loans. All it is if you're buying an investment property, a 1, 2, 3, 4 unit, maybe a 5 to 8 unit, maybe a mixed-use property, a condo, and you're putting down typically at least 20%. Qualification is based off of market rent versus any type of income documentation. So what does that mean? Say you're buying $1 million house, you're putting down 20%. Say that it's a 4-unit property, so there's 4 units to collect rent. That $800,000 mortgage, say at around 7%-ish, is $5,600 a month. Say you add taxes and insurance, say you're at $7,000 a month, for argument's sake, for that mortgage. Now, say each unit in rent of the 4-unit property, follow me, gets $2,000 in each unit. 2,000 times 4, for the math guys in the room, that's 8,000. 8,000 is higher than 7,000, which is the mortgage payment. There you go. Voila. Poof, as they say. You qualify for that mortgage. Why? Because the market rent is at or above what the mortgage payment is. Now, of course, there's credit guidelines. They want to see you have a pretty decent credit score. That means 660, 680, 700 or above. So they want to see a good or very good credit score for these. 20% down, they typically want to see you have that amount of equity, that 20%. You're putting money into the deal, so there's some equity for this lender. God forbid you don't pay, that there's some equity there for their investment that they're recouping if they foreclose, of course. And typically, they're not offered to people who don't own a primary house, meaning they don't have any type of proof that they've owned a house before. But for the investor community, these loans are amazing because there's no cap on how many you can do. You can pull 20% down and get a great interest rate. Typically, the rate on these is about 0.5% to 1% higher, which isn't all that much of a difference, right? And for the investor communities, they're oftentimes used to these private money or hard money loans, which are very, very bad loans. No bueno. Only because the rate's a lot higher. They're not fixed rate loans. They're typically 1 year that is just interest only. All that interest is collected at closing. So they're a little bit more of kind of like almost like you're meeting somebody on the street and they're giving you a satchel of cash type loan is almost the feel of it. These type of loans give you a safe 30-year fixed and something that the investor can hold on to and not have to refi after a year. These are all the popular loan types in non-QM, and reviewing how you qualify for each is far less documentation. Again, on a self-employed client, of course, they want to see that you have the money to close, but we're looking at bank statements, set of tax returns. Man, exponentially easier to qualify as long as they have the right credit scores, which is a little bit higher, and they can put that 20% down. 1099, cake. We're not looking at your tax returns. We're not looking at your expenses. We're going to take that 1099 form for the last year or two, and that's what you're going to use to calculate your income. And of course, asset-based lending, 1 or 2 months bank statements, easy enough. We work right off that. And then we save the best for last, the easiest, the investment DSCR loan. What's the qualification off it? Like I said, it's literally getting an appraisal, which is the valuation of the property, having that appraiser indicate what the market rent is, which usually you want it to be at or more of the mortgage payment, 20% down. That's it. We run your credit. As long as the credit works, that's what it takes to qualify. Way less paperwork than a QM mortgage. But of course, there's some differences, there's some pros, there's some cons. Let's hit upon each for a QM versus a non-QM loan. Some of the pros, some of the cons, the key differences are, take for instance a QM loan. Now typically they have lower interest rates, which is obviously a pro. You could usually, especially on a primary house, put a lot less down. You don't need 20%, you get away with 15, 10, 5, 3.5, maybe even no money down, which is very popular. There's also certain grants and FHA programs where there's no money as well. Allow for full seller concessions, so technically you could buy a house even with a VA loan, which is no money down, putting nothing down, and closing cost finance, which is super cool. They allow for sometimes higher debt versus the income that you show. So there's a lot of really cool features, especially everyone wants the lowest rate, right? Shop around, that's a QM loan. That's a big piece, is the low interest rate. But of course, non-QM, tons of pros. Maybe you just don't qualify, right? Again, in the case of Greg, him and his family, they wouldn't be able to afford a house. And as we said, why not just wait till you qualify for a QM loan? It would have cost them over $100,000 in tax liability to pay the IRS just to buy a house. Does that make sense? Do you want to stroke a $100,000 check just so you can then buy a house? Or do one of these loan programs they actually qualify for? That's a far better option. So again, it just gives people the ability to buy a house when they didn't have it before. Also, if you're an investor, it gives you the opportunity to increase your investment portfolio and not get risky loans. Get a 30-year fix with 20% down and find different properties and keep acquiring debt through real estate ownership. This is super cool. Why? Because some people, when they were buying, they'd have to get these hard money or private money loans that have a year until you have to pay it off in a balloon because they're not QM. They're not even subject to anything. They're almost like just super short-term bridge loans. This gives the investor the opportunity to have an increased portfolio without having risky loans or being concerned in a year, I'm gonna have to refinance it into a typical vanilla loan, which maybe they don't even qualify for because they're self-employed as well. Who are these loans geared towards? Who should use each type? Now, if you're W-2 and you're buying a house, you want to put a little bit of money down, you want the lowest rate, and you've been in the job force for a couple of years, of course, a QM loan is going to be for you, whether it's a conventional, which is Fannie or Freddie, whether it's going to be an FHA, a VA, a USDA, depending on qualifications, of course. Always do your consult with your loan officer, assuming they also offer non-QM and specialize in it. That's who's best geared towards a QM loan, a W-2 employee typically, or someone that's self-employed that actually shows a large net, or someone that's retired. There's plenty of demographic there that qualifies for a QM loan. Now, who's best geared for non-QM? You're self-employed and you write off all your expenses, which is probably, in my career, 80 to 90% of that type of clientele. Or you're an investor, you don't really show much, and you want to buy a 1 to 4 family or a condo or a multifamily over 5 units. They're going to be best geared towards the DSCR loan, which is non-QM, and that's going to be right in their sweet spot. If you want my free mortgage type decision tree, I'm going to actually put the link in the description below. Make sure you click it. It's going to show you the differences of non-QM versus QM and which one is best geared towards you in your specific situation. So now that we took a deep dive into QM, non-QM, and we talked about all the differences, the loan types that have a stranglehold on this industry, the best thing to do next is to speak with your lender and make sure that based on your buyer profile that you're going into the right mortgage type. But also make sure you watch our next video. We're going to talk about non-QM loans, take a real deep dive into the loan programs that fit in this mold and which one is the best fit for you.